In April of 1975, a small company sold its very first product for exactly $7,500, a piece of software so basic it could barely fit inside 4 kilobytes of memory. 51 years later, that same company is worth more than the entire economy of Canada, and its founder's old teletype code still sits, half-jokingly, at the root of everything running on a billion machines. This is the story of how a scrappy language interpreter written by two 20-somethings became one of the most powerful forces in modern technology, and how it nearly didn't survive its own middle age to get there. Welcome to Inside the Business, the channel that pulls back the curtain on how the world's biggest companies really got built, past the press releases and the highlight reels, into the decisions, the near collapses, and the bets that could have gone the other way. Today we're going deep on one of the most quietly dominant companies on Earth, so let's rewind to a world before it existed at all. Picture the computing industry in the early 1970s. Computers were enormous, expensive machines that lived in air-conditioned rooms and belonged almost exclusively to universities, governments, and large corporations. The idea of an ordinary person owning one in their home was, to most industry insiders, a punchline. The dominant players of the era were hardware giants, companies that built room-sized mainframes and treated software as an afterthought, something bundled in for free just to make the expensive machine actually do something. Nobody was selling software as a business unto itself, because nobody thought it was worth paying for separately. If you wanted a computer to do something, you either wrote the program yourself, or you worked at one of the handful of institutions large enough to employ a full-time programming staff. There was no retail software industry, no shrink-wrapped boxes on store shelves, no concept of an independent software company as a category at all. Programming languages existed, but they were usually written and maintained by the hardware manufacturers themselves, tied tightly to whichever machine they ran on, with no expectation that a small outside company could build a real business simply licensing code. That assumption was about to break. The spark came from two childhood friends from Seattle who had been obsessed with computers since their teenage years, sneaking time on university mainframes and writing programs any way they could. When a hobbyist magazine cover featured a new build-it-yourself microcomputer kit, the two friends saw something almost nobody else did, a signal that computing was about to explode out of institutions and into ordinary households. They called the kit's manufacturer, claimed to have working software for the machine that didn't actually exist yet, and then spent weeks in a frantic sprint writing it from scratch, testing it for the first time on the actual demo day. It worked. That gamble became the company's first product, a version of the basic programming language for an early hobbyist computer, and it set the tone for a business built on moving faster than anyone thought was possible. From there, the company's founders made an early decision that shaped everything that followed. They positioned software, not hardware, as the actual business. In a market where every other player was giving away code to sell machines, this small team insisted on charging for it, treating programs as intellectual property worth protecting and licensing. That decision, unusual at the time, effectively invented an entire industry. Within a few years, the young company had inked a deal with a computing giant to supply the operating system for its first personal computer, and through a combination of shrewd negotiation and enormous luck, the young company kept the licensing rights to sell that operating system to every other computer maker in the world. That single contractual detail, retaining licensing rights rather than selling outright, became the foundation of one of the largest fortunes in business history. But the story of steady, inevitable dominance is a myth. The company came close to losing everything more than once, and the sharpest of those moments arrived not in its scrappy earliest years, but well after it had become an industry giant. By the late 1990s, the company controlled the operating system on the overwhelming majority of the world's personal computers, and its executives believed the future of computing would run largely on their terms. Then the Internet arrived, and for a brief, dangerous window, the company that had defined personal computing looked like it might be defined by someone else's browser instead. Antitrust regulators in the United States pursued the company aggressively, and in the year 2000 a federal judge ordered it broken into two separate companies. The ruling loomed over the business for years, tying up leadership attention, draining morale, and creating a period where outsiders openly speculated whether the giant of the 1990s might fracture into smaller, weaker pieces. It took years of appeals and a change in political administration before the breakup order was ultimately overturned, but the scars of that period lingered. Engineers who lived through it have described a company that grew cautious and inward-looking in the years that followed, more worried about legal exposure than bold product bets, a mindset that cost the company dearly as an entirely new wave of computing began to form around it. The financial toll during those years was substantial, but the cultural toll may have mattered more. Executives who had once moved fast and made aggressive bets against competitors became noticeably more conservative, running new product ideas past legal teams before engineering teams, wary of anything that might look like the kind of behavior that had drawn regulators' attention in the first place. Product decisions that might have taken weeks in the company's early years now took months of internal review. Meanwhile, the outside world kept moving. A search engine started by two graduate students launched in the middle of the antitrust fight and grew, largely unbothered, into the default way people found information online. The company that had once out-executed every rival in the industry found itself, for the first time in its history, reacting to competitors instead of setting the pace. That new wave was mobile and cloud computing, and for the better part of a decade, the company that had once defined an entire technology era found itself flat-footed. Its attempt to compete in smartphones ended in one of the most expensive failures in corporate history, an acquisition written down to the tune of billions of dollars and quietly wound down a few years later. Its stock price, which had soared through the 1990s, spent roughly 14 years essentially going nowhere, drifting sideways while younger companies in search, social media, and mobile captured the imagination of investors and consumers alike. Inside the company, there was a well-documented culture of internal rivalry between divisions, sometimes described as executives spending more energy competing with each other than with outside threats. By the early 2010s, more than one industry commentator was writing the company's obituary. Not a company on the verge of bankruptcy, but something arguably more dangerous for a tech giant, a company on the verge of irrelevance. The turnaround began with a change at the very top. In 2014, a new chief executive took over, an engineer who had spent years quietly running the company's cloud infrastructure business rather than its flashier consumer products. He made a decision that seems obvious in hindsight but was genuinely risky at the time. He stopped treating the company's flagship operating system as the center of the universe and instead bet the entire company on cloud computing and cross-platform software. Signature products that had once been locked exclusively to the company's own operating system were suddenly made available on rival platforms. Internal culture shifted from insular rivalry toward what leadership described as a growth mindset, borrowed explicitly from psychological research on learning and failure. It wasn't a lucky break. It was a calculated, multi-year repositioning of an enormous organization around a bet that the future belonged to whoever controlled the infrastructure underneath everyone else's software, not just their own desktop. That bet paid off spectacularly, and it's worth breaking down exactly how the business actually makes its money today, because it's more layered than most people realize. A large and fast-growing share of revenue now comes from cloud computing, renting out computing power, storage, and increasingly artificial intelligence infrastructure to other businesses. Charge the way a utility company charges for electricity. Pay for what you use, scale up or down as needed. Another major chunk comes from productivity software sold as a subscription rather than a one-time purchase, a shift that transformed a business once dependent on unpredictable, lumpy software upgrade cycles into one with smooth, recurring, highly predictable revenue. Gaming, professional social networking, and a growing artificial intelligence assistant business round out the picture. Think of the whole operation like a landlord who also happens to run the moving company, the furniture store, and the utility hookup for every building in the neighborhood. Once a business moves in, the switching costs of leaving are enormous, and that stickiness, more than any single product, is the real moat. What's expensive is the infrastructure itself. Building and powering the enormous data centers that make cloud and artificial intelligence services possible requires capital spending on a scale that would bankrupt most companies, and it's a cost that only keeps climbing as demand for computing power grows. So where does all of that leave the company today? As of the summer of 2026, the company's market value sits at roughly $2.86 trillion, making it one of the largest publicly traded companies in the world, trailing only a small handful of rivals. Trailing 12-month revenue has reached roughly $318 billion, with profit margins above 39%, numbers that would make almost any other industry blush. To put that market value in perspective, it's larger than the gross domestic product of most countries on Earth combined into a single company built primarily on software and cloud infrastructure. But it isn't a pure highlight reel. The company continues to face scrutiny over the sheer scale of its artificial intelligence infrastructure spending, with analysts divided over whether the payoff from that spending is arriving fast enough to justify the expense, even as quarterly revenue growth has remained strong, up nearly 18% year-over-year in one recent quarter. The company's cloud division continues to report robust growth, and executives have pointed to rising adoption of its artificial intelligence assistant across millions of paid seats as evidence the next big platform shift is already underway. Still, the stock has pulled back meaningfully from its highs over the past year, A reminder that even the most dominant companies in history are not immune to investor doubt when the bill for the future comes due before the revenue does. It's worth sitting with how strange that current tension actually is. This is a company throwing off well over $100 billion a year in profit, with a cloud business still growing at a pace most industries would consider miraculous, and yet a meaningful share of the investment community spent the past year asking whether it's spending too aggressively on the very technology, artificial intelligence infrastructure, that's supposed to define its next decade. That's not the profile of a company in trouble. It's the profile of a company so large and so closely watched that every dollar of capital spending gets treated as a referendum on the future of computing itself. Employees inside the company describe an atmosphere of urgency around artificial intelligence that echoes, in some ways, the cloud pivot of a decade earlier, a sense that the company can't afford to be even slightly late to the next platform shift, given how costly the last late arrival, in mobile, turned out to be. Whether that urgency produces another decade of dominance, or another expensive detour, is genuinely an open question, and it's part of what makes this particular chapter of the story worth watching closely rather than assuming it's already written. There are 3 lessons in this story worth pulling out, and none of them are the kind of empty advice you hear in every business book. The first is that owning the underlying platform beats owning any single product built on top of it. The decision to retain licensing rights on that very first operating system deal, rather than selling outright for a quick payday, is arguably the single most consequential negotiating decision in the history of the technology industry. If you're building anything, ask yourself whether you're licensing your core asset or simply cashing it out. The second lesson comes from the antitrust years and the mobile stumble that followed. Dominance breeds caution, and caution, left unchecked, quietly becomes decline. A company, or a person, that spends years playing defense against yesterday's threat is far more vulnerable to tomorrow's threat than it realizes. The third lesson is about the turnaround itself, the willingness to cannibalize your own past success, to put your most sacred product on a rival's platform, is often the precondition for growth rather than a threat to it. Holding on too tightly to what made you successful yesterday is frequently the exact thing that stops you from being successful tomorrow. So there it is, a $7,500 software sale in 1975 that grew into a nearly $3 trillion infrastructure empire, not through some inevitable march of genius, but through one shrewd licensing decision, one brutal near-death legal battle, one humbling decade of stagnation, and one calculated bet on the cloud that arrived just in time. That's the real story behind the household name, not a straight line, but a company that came dangerously close to being remembered as a cautionary tale before it rewrote its own ending. If this kind of story is the sort of thing you find yourself thinking about later, send it to the person you know who'd get just as into it as you did. And if you want to stay on the inside with us, to keep getting the real story behind the logos you see every single day, this is exactly the kind of thing this channel exists to dig up, so stick around for it. Next time, we're going inside a company that started as a side project inside someone else's failing business, and ended up controlling how half the internet gets paid, and the founder almost walked away from it twice before it ever took off. See you inside the business.